everyone. I'm Julie Chan. I'm from PwC. Let me do a quick, intro on the FinTech Association, because I'm just conscious we might have some people who signed up by Eventbrite that might not be aware of the association. And then I'll let Neil introduce our topic for today and the speakers. So for those of you who are not, who are new to the FinTech Association, a very warm welcome to you. So the Hong Kong FinTech Association is an independent, not-for-profit membership-based association, and we represent the Hong Kong FinTech community. So as an association, we focus on three things. So advocacy for development and greater investment into Hong Kong FinTech. We collaborate with other organizations who have similar goals to us to create a vibrant FinTech community. And then we educate and raise awareness of FinTech by holding regular committee meetings and events such as this one today. So WealthTech committee, so Neil and I co-chair this committee. We're one of 8 committees in the association. And as the name suggests, we focus on asset and wealth management industry, and we explore opportunities and challenges, in the digital transformation journey industry facing today. We have a diverse member base, but we're always open to new members to bring additional and fresh perspectives to our discussions. So we do meet on a monthly basis on the first Wednesday of every month at 6 p.m. So reach out to Neil and I, or we have the FinTech Association team here as well. If you'd like to find out more on how you can get involved, okay? So I've got a really exciting session for today. I'll hand over to my co-chair Neil to introduce the panel. Over to you, Neil.
Great. Yeah, thanks, Julie. So today, we've got a great event put together here. Robo Advisors, the future of wealth. Essentially, my name is Neil Tan. I'm with HSBC, and Julie and I are co-chairs and moderators for today's event. Before introducing the speakers, I wanted to try to frame the discussion and share a little bit more about the market opportunities. So if we take a look at Robo Advisors, the global market, on aggregate, the AUM is expected to reach 1.3 trillion within this year, 2021. Now, that's expected to grow at a blistering pace of 20% CAGR over the next 4 years to 2.9 trillion by 2025. Now, having said that, the global AUM, including robo-advisors, is over 75 trillion. So, we've got quite a bit of a runway there, if you know what I mean. So there's a huge opportunity for robo-advisors to take up additional AUM from there. And if we look at it from a geographic perspective, the #1 robo-advisor market globally is the United States at 1 trillion of the 1.3 trillion currently. So what that means is essentially Asia Pacific has a fair amount of growth opportunity there. So moving forward, so I wanted to kind of introduce the 3 speakers today. So we've brought together 3 of the leading robo-advisor players inside of the market within Asia Pacific. The first one is Sebastian Cyber, who is the co-founder and head of distribution with Syfe in Singapore. We also have Tim Jones, who's the founder and CEO of FTAHK Hong Kong. And we also have Vivek Mahindra, who's a co-founder and responsible officer for Crystal AI. So welcome to the panel. Why don't we just kick it off with a quick introduction of yourself and maybe the firm, and we'll go from start it off with Sebastian and then head down to Tim and Vivek. So I'll hand it over to Sebastian.
Thanks for inviting me, especially honored because we are Singapore-based digital wealth manager. So very excited to be here. Speaking to the community in Hong Kong. About myself, yeah, my name is Sebastian. I'm new to the industry in a way. I spent the last 8-9 years actually in e-commerce. Was the CMO for Lazada Indonesia, spending there like from launch all the way to after the acquisition by Alibaba Group. So it's one of the 2 big e-commerce players in Southeast Asia. And Dhruv, who founded Saif 2.5 years ago, brings in the banking background, and we together basically try to combine some of the techniques of the finance industry and match them with some of the areas where e-commerce might be more advanced, to provide a platform for saving and investing to retail clients in Singapore and globally. Yeah, so I think that's already the most important part about Saif itself, right? I think we see ourselves more as a wealth platform rather than a robo-advisor. We cover everything from savings to investing. And yeah, I think, as I said, very excited to be here. Happy to answer questions as they come along.
And over to Tim.
Hi there. So yeah, so similarly, thank you ever so much for having me on the event. Looking forward to talking a lot about what I think is going to be happening in the industry. So a little bit about FTAHK first, and then myself. So FTAHK is the ultimate technology-driven investment platform, and we are the world's first investment platform with performance-only fees. And so what that means is that, unlike traditional investment advisors, we only charge a fee to our customers if our advice leads to positive returns. So it's a little bit about me. So I'm the co-founder and CEO of the business, and came into this from a slightly different industry as well. So not quite as far as e-commerce as Sebastian there, but I worked in insurance before this, and I came into this having worked at Aviva, so the UK's largest insurance company, and worked with them around the world, from the UK to Singapore and then Hong Kong. And it was just from the very simple observation that in the rest of the world, insurance companies sold insurance products, which made complete sense. And then here in Asia, the observation that insurance companies sold savings products, and that made much less sense. And so looking at the rest of the world, and sort of picking up on your point that the US has got $1 trillion of that 1.3 trillion of robo-advisors, there are lots of solutions around the rest of the world that could be put into place here. And so set about creating a company and creating FTAHK to then put those ingredients together to create a savings and investments platform here for Asia.
And over to Vivek.
Yeah, hi. Thanks, Dave. So yeah, we are one of the oldest, I think, FinTech companies in Hong Kong. We are the founder members of FinTech Association. So a lot of people on this call will be familiar with us, I hope. Yeah, we've been around for about 4.5 years. We started off in Hong Kong, and then we got licensed in Singapore and India too. So we're multi-country. I'll cover something about how Hong Kong has grown vis-a-vis Singapore and the other countries. But we don't like to call ourselves just robo-advisors. I think what our main focus is we provide digital advice. And the reason for that is we believe that the digital advice is unbiased. Rather than having sales forces selling your products, once you rely upon algorithms, digital advice, and artificial intelligence, you end up with relatively unbiased advice. We cater to retail investors also. We've got about 25,000 of those. But our focus increasingly has been on the mass affluent, the people with, like, let's say, $500,000 to $5 million range. And that's grown quite rapidly. So that's kind of, HSBC Premier or DBS Treasures or HSBC Jade maybe. So we have about 250 million, about $250 million under management now, growing quite rapidly. And we provide the whole gamut of products. So we go right from ETFs up to stocks, bonds, growth funds, hedge funds, pre-IPO, secondaries. So I would say that on a current level basis, we would probably be able to provide better access to products than any other private bank out there in Asia on a single platform. So what we do is we provide digital access and do it on an unbiased basis using technology. So we have over 80 people now. And I think we're growing quite rapidly and quite happy with the progress. COVID has, for whatever it's worth, has been quite decent for us. Thanks.
No, thanks for that quick introduction. What do you guys see? I mean, you know, if we take a look at the States, I mean, there are roughly around 200, 300 different robo-advisors in there. I mean, it's getting more and more crowded space. I mean, how do you guys see the different trends inside of Asia Pacific? Also, how do you see yourselves kind of differentiating yourselves in that sense? Maybe, Vivek, if you want to give it a, you know, we'll go through the line.
Yeah, actually, there's like there aren't that many robo advisors in Asia. I mean, of course, it's quite crowded in US and Europe, and again, even there, it's been a kind of consolidation across certain players. So I think, you know, we only have like 2 or 3 in Asia that we kind of focus on and think as, you know, having a mass market. Ultimately, you need a lot of data for us also. For us to fine-tune our algorithms and digital advice, it took us almost 4 years of experience and about 20,000 people using our algo regularly. We have almost 500 people running our algo and taking advice on a weekly basis. So I think, you know, but the key differentiator for us is our background is trading. So I've been in Hong Kong for 15 years trading with the various banks. And the CEO and the co-founder is also from a hedge fund. So we bring in the, you know, the trading aspects of it, because ultimately investing is about trying to make money. As you know, Tim mentioned, you know, ultimately we are trying to deliver performance. So the background is trading, and the second is we are moving down from private wealth to retail. So a lot of the products that we develop are developed for mass affluent and private wealth, and we use, because ultimately we have to generate revenue. So the private wealth people pay us money, and then we use that to give a very discounted offering to retail customers. So retail customers get a very good, sweet deal from us, primarily because the private wealth people are paying for a lot of the things that we develop, and also, you know, a lot of the products that we put together.
How about yourself, Tim? How do you see it, the different trends and also the differentiation?
Yeah, I think take a slightly different assessment in terms of sort of the number of players and therefore whether it's crowded and sort of an untapped market or not. And so actually I see a very different way, and kind of tie more back to your initial stat around only managing 1.3 trillion over the nearly 100 trillion of AUM in total. So I think even in the US or here, I think actually we view that WealthTech is actually only about 1% done. And so when you look at a lot of those players that have come to the market already, WealthTech has kind of been viewed very much as a robo-advisory type proposition, which is very much a product-centric view. So if you look at a lot of those players in the US or some of the early robo-advisors here in Asia, they've taken a platform to create a product, whether that be a proprietary product or a very simple product, and then just made it available for people to be able to purchase online and digitally. Wealth management as a service is then significantly more complicated and sophisticated than that. It's about setting up plans, it's about populating those plans with independent products, managing those products over time, and then providing advice on the suitability of that. And so our view is that's only 1% done, not just on the fact of the AUM statistics, but actually just on the fact that that service hasn't really been tackled at all in the digital, whether you call it WealthTech or robo-advisory level. And so that's really what we're trying to do as a company, to kind of shift from that product sales centric view to a holistic service orientated sort of technological solution to that. And on that basis, I think even around the rest of the world, there's huge opportunities. And really, it's only just started, so really exciting.
And Sebastian?
Yeah, just to add on top of this, I think the fact that there's only such a small portion of wealth actually managed by digital wealth managers right now, I think shows where there's the actual competition, right? I think the competition is either just a bank savings account, right, where people are currently earning close to nothing on their savings, right? And we are providing them alternatives to that, and overpriced and often poorly managed, like unit trusts and similar products, right? And I think by offering a digital low-cost access to sophisticated products, right, I think that's what I feel is the value add we are providing, and not, to be honest, not only as us as SIFE, but as the industry, as digital wealth manager or other robo advisors, right? So I don't see as much the competition between these robo-advisors who combined hold 1% of assets, but much more with some of the traditional players, traditional asset managers, yeah, and so on.
How do you guys, you know, robo-advisors are meant to kind of provide accessibility to, you know, once underserved or unbanked individuals and so forth. I mean, I think that's kind of the target set. How do you deal with that, and also the personalization piece inside of that to, you know, really understand, let's say, you know, risk profiles and, you know, they're goal-based and different themes and those different things. And how do you address that inside of, try to strike the balance between addressing the bottom of the pyramid and at the same time trying to personalize the offer? Maybe Sebastian.
Yeah. I think that's the great thing about like being also a tech business, right? And I think we are, as SIFE, we are as much a finance and investment business as much as a tech business, right? I'm coming from a different industry. Nevertheless, more than half of our employees are actually former bankers and investment professionals, but the other half is really like technology people, and we use this knowledge to provide a personalized solution, even if it's not done by a person, right? But by technology. And I think that's one of the key advantages we have, is that even for the segment which is, let's say, below $20,000 we can offer some form of personalization, right? Which usually is not possible, especially not with the fees we are charging, right? If you're talking about 40 to 65 basis points per year, right? I think what we as SIFE have nevertheless decided to do is that we are also offering this human touch, and we are having a team of so-called wealth experts, which help people, especially in the beginning, to understand our offering, to understand what we do, and even give you know, this a bit of extra human touch for people when they need it. This is something complementary as of a certain tier. And we see that some people are very interested to use it. A lot of others are not using it. So I think it's really something which is an offer from our side, and then it depends on the clients who want to take it up or not.
How about yourself, Tim?
Yeah, I think also it's interesting when thinking about personalization. I think first you can take a view on how much personalization is valuable. And when you're looking at the retail segment, there's lots of aspects of it that are valuable, and there's lots of aspects of it which are not, and not in a bad way, in a sense that lots of retail wealth management needs are quite homogenous. If you're saving 2,000 Hong Kong dollars a month and you're saving for 20 years, like actually your long-term sort of retirement savings needs are very similar to the next guy. And so on that basis, actually you don't necessarily need to have lots of personalization if that personalization brings in lots of cost. And therefore actually personalization is not helpful. But what we found is that where personalization is necessary, is actually helping people make those choices in the first place. And so like every other industry, fund management and investments, there's a paralysis of choice. There's too much choice, and actually personalization can actually lead to a hindrance, not a help. And so we've actually had to work quite hard to create a kind of matching algorithm to kind of help map back sort of personal values onto the applicability of different funds. A little bit like you have a sort of Spotify Weekly to help you choose all the different songs. Now, underlying, your kind of asset allocation might be very similar between one person and the next, but having some kind of personalization on the top around things that match your preferences, that's where technology can really help and add value, and in a very low cost way, because the cost of doing so isn't very expensive. So we think about personalization in a couple of ways then, where certainly actually adding it in is not that necessary, and then secondly the bits of personalization that relate to you as a person, and how that maps into your values, and that's where technology can really be value add.
Yeah, so actually, yeah, carrying on from where Tim and Sebastian saying, so there's like a few points which kind of resonate with us also. One is the one about paralysis of choice, right? So, I mean, there are like, 30,000 ETFs, so there are 25,000 funds. I mean, there are like 100,000 stocks, and, it's just crazy. So basically, I think one of the things that we've realized pretty early on is that we need to curate this. So we only show, let's say, a few hundred ETFs, and we will show about 100 funds and so on and so forth. So, we've kind of gone through them, and this is not done by manually, but it's done by the algorithm. And yeah, in fact, it also ranks it. And in fact, we do it for even stocks. So for stocks, ETFs, funds, all of them, we will actually come out with a ranking list, and which changes every couple of weeks, but some curation done there. The second is the hybrid approach, right? We started off with a smaller employee force, and totally reliant on technology, but we've come up with a hybrid model where there is some human interface and there's some human touch, especially for the slightly wealthier customers, and then we have a differentiated offering for the regular people. On a customization space, yes, I mean, it's very difficult to customize for $1,000 customer. I mean, there's only a limited things that he can invest in. But, as the amount increases, the level of customization is greater and greater. Of course, at the professional investor or the accredited investor level, you can do a lot more things than, we're even putting Bitcoin or something like that in portfolios. So, it depends over the, over the size of the customer account. But at a smaller $500, $1,000, it may not make sense, even though we can use technology to deliver it. It may not exactly give that much value to the customer himself. That's kind of our views, yeah.
Actually, yeah, you brought up an interesting point. I mean, you've got the digital asset exchanges that are coming online. You've got OSL, you've got HA BitX that are all going for these types of licenses. And, how are you guys viewing these so-called alternative assets, whether it's crypto, whether it's, tokenization, those different things? Maybe Vivek, if you can.
Yeah, I think people don't understand that we could not have launched this fintech, this company, if we didn't have access to all the other things available to us. For example, we had APIs integrated with Interactive Brokers and Saxo. We have digital identity in Singapore with MyInfo, and in India with CKYC, and hopefully at some stage in Hong Kong in the near future. It's like, it's a never-ending race, but I think I Am Smart is coming eventually along with the vaccination. So many of these things, at least we use WealthTech. So many of these things would only be possible. A lot of things that we can deliver are only possible if we can use different platforms. Like for funds, all funds, and further for hedge funds and some of the private equity, Moonfair. I mean, there are many platforms that we kind of partner with in order to give all the products available to our customers, and it's not possible to do it alone. Even for bond trading, we have Bondi Value in Singapore. So I mean, and even if you go down to services like Zoom, we're using Zoom, right? We're using Zoom, we use Slack, we use Jira from Atlassian. I think at the last count we were using 25 different software vendors for our technology, and that's what makes it possible for us to deliver a reasonable experience to our customers. And so we are happy to work with all these platforms, and one of our goals is to integrate all these platforms so the customer sees only one thing. They only see Crystal, and at the back of end we are through APIs, straight through processing, we are executing with multiple layers of partners.
How about yourself, Tim?
Yeah, so I'd say, I mean, for us, it's slightly different given the target segment that we're going after. And picking up what Sebastian was saying earlier, like at the retail level, our key competitor is cash in a bank account. And so if you kind of put yourself in the shoes of a retail customer here in Asia, it's people who find the whole world of investment daunting. BCG does an annual report on the sort of state of wealth around the world. And they find that 80% of 80% of wealth in Asia, in the retail segment, just sits as money in the bank. So there's a lot of chat around cryptocurrency, about investing all these other assets, investing all these other sort of products and platforms around there. Actually, people don't use them for a retail segment. And really what people need is actually that helping hand to start in the first place. So at the moment, we've got we're an ETF only platform, and there's a huge amount of segue for us to get into in using that. And so if you're thinking about starting your savings and investments journey for the first time, actually you need to take your first step out of an asset that gives you 0% return into just a balanced set portfolio of debt and equity, or bonds and equities to begin with. So that's really where we're at as a business at the moment.
And similar for Saif. So I think what we provide is we don't try to provide every single stock and fund which is out there, but we try to provide more a curated approach, and we say we want to try to find the best possible product for every objective or for every purpose out there, right? So just as an example, our cash management solution, right? We said, okay, this is what we think is the ideal place to park cash for 3 months or longer, and this is what we try to create. Instead of offering every single bond fund which is out there, we have created one portfolio consisting of 3 different funds, which we believe make up a very good place to park cash. So so this is a bit our approach. We don't only use ETFs. So for us, it really depends on what kind of product do we want to create. We have products which are based on ETFs, but we also have products where we buy the underlying stocks directly, or even as in the case of the cash management solution, buy funds directly from the issuer, not on the stock exchange.
I forgot to mention, I mean, it's great, you know, the audience can type in different questions inside of the chat. So just get it a little bit more engaging in this respect. So from Ali, please explain how one can create an unbiased allocation model. If we can answer that question, maybe Sebastian, you want to kick it off?
Yeah, I think for us, like the key is the 2 things there. One is that all our investment portfolios are purely like quantitative models. So yes, there is a certain element of active, or not really active management, but the portfolio allocation will change over time, but it's purely a function of the algorithm or the quantitative model behind it, right? Yes, humans do create the models, but then once it's actually running, there's no intervention except for some bells and whistles, you know, like to always make sure everything is going well, right? I think that's the key part of, for us at least, how we create unbiased models. I think the other part is that we are not dependent on any, or we are not related to anyone who issues funds or anything like that. So we are very agnostic to what we use. And as in my previous answer, right, we use ETF when we believe it makes sense. When, you know, for example, from a trading point of view, they're just the most cost efficient. But we also buy the underlying stocks directly, like in the case of REITs, which are listed on the Singapore Exchange, which we buy directly, right? So we will always choose whatever makes the most sense for the client.
I think if I can sort of step in next, I think actually for us, we create a sort of a template-driven approach for customers to be able to pick the model portfolio or the asset allocation that they find most suitable to them. And I think that's a way to help answer that question, which is, as soon as something's designed by the company or by the provider, there's obviously inherent risk of buyers coming into that. And so what we've set up is a way for actually customers to be able to change that asset allocation in whichever way they see fit. Now, there's obviously prompts and suggestions and templates to help navigate that. But what you can then do is that you can then see what's the likelihood of success on any of those portfolios. And so we've then got the ability for customers to make any changes that they want later down the line, and kind of the control is then in their hands. And that, what I think is the sort of the line that sort of WealthTech or Robo advisors will then sort of like work through over the course of the next 5 to 10 years is how much is preset by companies or by algorithms, and how much control and help and sort of guidance is then given in the hands of customers to then take that themselves. And I think that'll sort of like iterate over time and to kind of see what works best.
Yeah, I think, it's the same thing, comes back to the same thing, if you're not paying anything, then who's the product, right? So, you probably are the customer, maybe the product themselves if they're not paying anything. So, from our perspective, we charge fees. So, earlier, we had obviously, some freemium models also, but now we charge fees to all customers, between 0.3 to 0.5%. But that kind of makes sure that our revenues are coming from the investors rather than we're getting money from other sources, and therefore our interests are totally aligned. So there's that kind of keeps us on the straight and narrow. The other thing is that we actually let the algorithm overrule in most cases. So while we may fine-tune the algorithm and we may try to make changes in the algorithm itself from time to time, and we have an overlay in terms of our investment committee views on the algorithm, but what it finally comes out with, the results, we do not change. So from the retail investor perspective, he doesn't actually. There's no way for us to change the results that he sees. So that's kind of creating a very unbiased kind of allocation from there. Where do our revenues come from, and where does how does the algorithm work? Even for the ranking, etc., everything is done automatically. We did have a discussion. I didn't like some of the results sometimes, but we decided that we will just follow whatever it says without question.
Right. Question from Richard Shum. Why should algorithms be trusted when they haven't been around very long? Who is responsible if something goes wrong? So maybe Vivek, you want to...
Yeah, well, at the end of the day, I know we've had this discussion with the SFC before. I mean, that's why I have a designation called the responsible officer. So, ultimately, I assume I will be responsible if something goes wrong. But I don't know about that. Yeah, but but we've been fine tuning the algorithm from time to time. So from the regulatory perspective, each regulated entity has some people who are responsible, and ultimately, since we developed the algorithm, we are responsible to that sense. Haven't been around very long. Well, that's you can say that for many things in today's world. Mobile phones haven't been around that long, but everybody trusts them. And then so I think it's a question of how technology is improving and how at what pace it's improving, and whether it improves your ability to do some things. And I think that while the financial theories have been around, that's what I teach this subject, and modern portfolio theory is now 60 years old. So the Black-Scholes option model is another 60, 70 years old. So there hasn't been any developments in financial theory for 50 years or more. However, our ability to use technology to deliver them on a cost-effective basis to people has changed. And if we can do it, why not use it? We didn't have the access to Amazon. So, for example, Crystal is on Amazon completely. We didn't have access to cloud computing 5 years ago, 10 years ago, to the same extent that we have today. So now we have access to it. We should use it. If we had access to it 20 years ago, maybe the algorithms would have been there for 20 years. But this is how it is.
And just to add on to this, right? Apart from using proven models, right? As Vivek mentioned, it's also not really a black box, right? I think it's the same for Crystal AI and FTAHK. But on SciView, basically, as the client, you can see exactly their portfolio allocation or the asset allocation, right? You can see how much units do you hold of which ETF or which stock, right? And you'll be able to see, if you go just as a core portfolio as an example, that 10% of your assets are in an S&P 500, there's 5% of this. So there's a lot of transparency for you to see what actually is in your portfolio and what do you actually buy. And you see this before you invest, before you transfer funds, and you can see the exact amount on every single day through your app or web application.
Yeah, I think sort of picking up on that, and so I think you can take that question and actually take it further. So it's not what algorithms have only been around for 4 or 5 years, so therefore why can we trust them? I think you take that question. The heart of that is algorithms are based on the basis of making active bets and active fund management. And so really at the heart of that is, do you believe in active fund management or not? And you look at the results. So SPIVA is an annual review that comes out of the SP Dow Jones every year. 90% of all active fund managers fail to beat the target benchmark. So whether it's active fund management from an algorithm or active fund management from some guy on Wall Street, why is it that you think that you can outperform the market? And that's basically saying you're standing there as an active fund manager, either with an algorithm or not, and saying you can predict the future. It's a very difficult claim to make credibly. No one can predict the future, and that's why actually 90% of these funds fail. So really, our view is that we don't have active fund management. We don't have algorithms that try and pick stocks. BlackRock, that they've looked at all of their portfolios, they found that 94% of all of the returns that come from a portfolio are generated by the asset allocation. Nothing to do with stock picking. So stock picking and market timing account for 6% of the returns of a fund. 94% is driven by your asset allocation. And that's really simple. That is, if you're saving for a long time, invest more in equities. If you're saving for a short time, invest in debt, invest in bonds, safer assets. So really what technology can come in to do is actually help people set up wealth management plans, i.e. the asset allocation out, discipline to make contributions, help people set up their wealth management plans in a way that take cost out. Because all of these active fund managers, they have high fees in there. And so really that's where technology can come in, not in creating algorithms, but in creating low-cost access to funds in a way that was never possible before. The funds in Asia, the fees in Asia, and that's why it's so exciting here. The benchmark is just so low. You can pay 2-3% per annum through traditional funds, sort of traditional mutual funds and traditional financial advisors. Using technology, you can get that down to 0.5%. So that's where I think the value of technology comes in. It's actually taking cost out and helping people set up right. And as to the question, it's not in trying to predict the future, because no one can do that either with an algorithm or not.
Yeah, I just want to carry on to that point. You know, the benchmark, like you mentioned, the benchmark is really, really low. I mean, on a Hong Kong MPF, you're paying 1.7% average cost, right? Everybody's happy with the Hong Kong MPF this year because, you know, Hang Seng is up, so everybody's made some money, so everybody's happy. But, you know, come next year, I mean, for the last 10 years, I've been hearing complaints about, you know, what kind of returns people have got. But of course, last 1 year, I've heard all positive things. So, you know, what I mean, the benchmark, I mean, the costs which people are, with the general investor, the retail investor is paying for standard products in Asia is you know, hugely negative. And you know, even though, you know, you have a financial center in Hong Kong, you have a financial center in Singapore, you know, the benchmark unfortunately is extremely low. It's only just now that the zero commission brokers have come in, and a lot of these, the ETF market is still highly underdeveloped in both locations. You know, there's very few ETFs. I'm again hopeful with the budget and the stamp duty going up on stocks that, you know, ETFs will do better and there will be more flows there. But, you know, currently, you know, there's very low flows in ETFs. There's not much variety, but there's some positive, you know, things happening. You know, a lot of flows going into China bond ETFs. So that's, you know, that's very favorable for Hong Kong markets. You know, and so on and so forth. But yeah, but the benchmark is currently really low in terms of what are the alternatives available to investors, whether they be retail or mass affluent. Even a mass affluent guy with $1 million US has very limited options in Asia about what he can do with it.
One more question from William Berkshire. A key element of attracting retail customers is trust, e.g. Mox Virtual Bank got 80,000 customers now. How, as unknown firms, do you overcome this versus banks and established names? Maybe Sebastian.
Yeah. Yeah, if you fully agree, right? I think trust is definitely the biggest challenge, I guess, for all of us, right? Building this takes some time, but I think there's also like certain things which really help with this. One is, I mean, we are regulated by the MES, right? I think that's for a lot of customers here in Singapore, really a trust mark is a very, like probably one of the most reputable central banks in the world and or regulators in the world. But I think there's also other things which we as a wealth manager can do. One of the things we do is we have intentionally said there's no minimum to invest with SIFE, right? And this really helps people to overcome some of these barriers. People can start to invest with Saif with theoretically $1 and they will get the same portfolio as someone who invests $1 million with us because of the fractional share ownership, which our platform supports. And we have seen that this really works for us. People come in with sometimes tiny amounts. They see how the platform works. They see what asset allocation, how many units do they get. They even try to withdraw and see how long does it take until they have their money back in their bank account. And after they have seen that this works very smooth and simple through the app, they suddenly make a significant deposit, and they while the first deposit was $100, the next deposit is usually $50,000. So I think this is one of the ways. I think the other part, and this is what we try to do quite a lot, is like we work with our existing clients and get them to share their experience with their friends or even publicly. And I think this really helped to build some of the trust by simply existing clients sharing their experiences.
Tim, you have any?
Yeah, I sort of picking up on it. I think sort of like products sell themselves, and I think if you look at where these markets are more mature in other parts of the world, like there's been no issue with people adopting new fintech platforms. I mean, like has Robinhood had the trust issue because it wasn't backed by a sort of Bank of America? No, right? And I think the learning by looking at sort of the development in other parts of the world is like when the product works, and picking up from Sebastian's point, then existing customers want to refer it, then that's what overcomes any issues around hesitancy on that. Now, the other stuff I think around being licensed, so the signals around sort of having that license backing, about having sort of whether it's sort of a deposit protection or sort of the investor protection trust element in there, that sort of other regulatory kind of safeguards are all helpful. But yeah, I think it's actually the other way around. Like there's a huge inherent mistrust with the incumbents, with the likes of the established banks in terms of the way that they've imposed lots of punitive fees and charges and clunky processes and forms and things that actually help people mistrust the incumbents. So I see it the other way around. So if as a startup you can get your product right, you're in a huge advantage in terms of trust, because people are willing to try those things if the product just works.
What about yourself, Vivek?
Yeah, of course, I mean, trust is an important thing, and especially with us, because we cater to mass affluent. So, the minimum, some of our clients are millions of dollars with us. So, licensing is an important factor. So the fact that we are licensed in multiple countries, gives it. But again, it's more to do also with the geography. I mean, I think last year I shared this. Maybe I can share it again in terms of what. I'm going to share the screen because I've been waiting to show this. This is the difference between Singapore and Hong Kong in terms of, how do I get this thing? Okay, let me see. Between Singapore and Hong Kong in terms of robo advisor, So if you look at this, I find this very, because I've been here in Hong Kong for 15 years, and my partner sits in Singapore, and this is the projected growth in the last in the next 2-3 years. This was, I think, done by was it PwC or KPMG, one of the two, I think. The user penetration, so it's only 1/3, and I can actually see it in our daily signups. I can see this 1:3 ratio in terms of AUM, in terms of clients, and so it's I'm going to stop sharing it. But basically, this is the story is firstly there are early adopters, and there seem to be more early adopters in Singapore compared to Hong Kong, and there's a process and there's a time gap where trust builds up. And it does take time, especially with financial products, and it took us some time, and it's going to take everybody some time. But it's also to do with just how people are, and you can see, because even though we started in Hong Kong first, we can see the growth in Singapore much rapid.
Question from Emmy Fong: how many robo advisors globally have reached sufficient scale? What needs to happen to unlock greater usage of robo advisors in the marketplace? So maybe Vivek.
Yeah, I mean, I think in the US, of course, this has been it's I think the US has a 5-year advantage over us. So like, for example, we started in 2016, end of 2016, early 2017. The big robo advisors in the US started somewhere in 2011-12. And obviously they have reached the sufficient scale. Betterment, Motive, Wealthfront are all at a significantly scale. But you have to also see that many of the incumbents have also launched Robo advisory offerings, which have again, have really become huge offerings as such. So the fintechs have kind of catalyzed some changes with the existing incumbents in terms of offering the new products. The products itself, as I mentioned, are not that complex, and it's not as if this finance theory is new, or the algorithms or the computing technology is not available. It's just a question of the chemistry with which you offer these products. And in some cases, like for example, some of the big advisors have actually, existing companies have started offering these products and quite, and customize them quite well, actually, I would say. But yeah, many advisors in the US, and I think hopefully there will be quite a few in Asia over the next 2-3 years.
I think just to add on to this, I think what I find fascinating about this industry is that most players actually do charge fees which I believe are sustainable on a long term. I know Crystal AI moved away from their freemium model to a fully paid model. We are charging fees from our first day onwards. We have been charging fees and making revenues. I feel, even it depends of course a bit on the market size, but I think you can run a digital wealth business with $1 billion in AUM and be profitable probably. So the barrier, in my opinion, is relatively low compared to actually other industries. Even in payments, right? It's still, yes, companies have reached massive scale, but it's still very unclear how they actually really monetize this and how they can turn this into a sustainable and profitable business, right? I think we are actually very lucky to be in an industry where we can still charge fees which allow us to build a sustainable business. The question is, how will competition affect this? But even looking in the US, yes, fees have gone down, but are still in an area where I believe they have a very profitable business.
Okay, sorry. We'll carry on.
Okay.
Oh, sorry. Okay. No, the reason we started charging was because none of our clients cared. Actually, we had a freemium model, and then we switched to a paid model, and then the clients didn't. Not even a single client complained or withdrew his money. So we looked at it and we said, like, it doesn't make sense, because the clients don't really care about 0.3%, 0.4%. They're more concerned about the product rather than anything else. So
this is a huge difference to payments, where if you give a $5 discount, people will change, right? Because loyalty is very, very low, right? I think that the one of the great things about wealth is that, yes, it requires a lot of trust, coming back to previous questions. But once they have found this trust, I think they are very sticky and they're willing to pay for these services.
I think the nuance is in the language and where you describe it. I think customers are very sticky, and they end up paying fees in wealth management. Whether they are very happy to pay fees, I think is a whole nother matter. But yeah, I think in terms of then, I think that no matter how you describe it, like the outcome is that fees are not rapidly competed away or eroded away for lots of these products. But I think the way we look at it is there's a big difference between products and services. And so I think on a product basis, fees will start to, if you are simply just shipping product, those fees are very competitive. And so you've seen that through stockbrokers. That's where the product is as simple as it possibly could be for the space of wealth management. So their fees are very, very, very low slash free. When the product then gets slightly more sophisticated, so packaged portfolios, they'll be a little bit longer in terms of the sort of relevance of fees there. And I think when you then move into sort of holistic service, that's when there will then be much more protected sort of fees in the long run. And I think viable businesses will be ones that sort of focus on actually providing service as a whole, rather than just sort of shipping product.
Great. Question from Minal Agarwal. Recently, GS made its Marcus Invest tool available to a new wealth demographic. What kind of challenges do you see going ahead, wherein these banks are now trying to capture a customer base that was mainly untapped and mainly catered to by fintech companies like Aquaman, etc. Sebastian, you want to go for it?
Yeah, so I think incumbents will launch similar services. I think there's no question about that. I think there's two problems incumbents are facing with this. One is to a certain extent the mindset you need to have in order to run a real tech business, and I think this has been seen over many years throughout different industries, right? That somehow, regardless how big the incumbent player was and how dominant they were, there have been tech companies come in and disrupt industries. And I don't see the big difference there. An Amazon coming into the US. Why did Walmart not win this? So I think I think this is part one, and part two is that I think incumbents face another problem, and this has to do with something I think Tim mentioned, right? Is some of their or Vivek, right? They're charging significant amount of fees on entry, on exit, on management fee, trailer fees, and these incumbents basically need to be willing to compromise on some of these revenues in the short term if they want to really go for a digital approach, right? Or if they want to seriously launch a digital wealth offering, right? And so far I see that that a lot of banks are not willing to do that because a lot of their revenues come from these products.
Sorry. You go this time first, Tim.
I say, yeah, I think, and that point has definitely manifested itself in Hong Kong. So you've had the virtual banks launch here, and lots of them are talking about their wealth management offerings. But because of their cost structure, like they're capitalized like existing banks, there's no difference in the capital requirements for the virtual banks versus the existing banks. And so they're looking at wealth management as a way to recoup some of their high costs that they got baked into their business models. And so as a result, that they're linked with mutual funds with high underlying fees, with the trailer fees and all that kind of stuff. So I think, yeah, sort of inherent in their DNA is sort of processes to recoup costs that are there and difficult to get out. And that's where there's a fundamental difference between incumbents launching products like this and then startups who are really starting from a blank sheet of paper.
Vivek?
Yeah, I think the main thing is that the difference is quite big. I mean, in terms of retail banking business, I think Hong Kong is probably the highest per capita revenue made by financial services industry in the world globally. And of course, part of it is because there's such a high level of deposits that people keep here, and people end up paying a lot of revenues for all of these products. Yeah, so from our perspective, I think the benchmark is so high that there's a lot of room to maneuver in. Yeah, incumbents will keep launching. I mentioned myself, like there have been 3-4 launches, and they will continue to do that. But it's to do with the DNA of the organization. It's to do with your existing cost structure. It's to do with your ability to restructure your revenue streams and look at it differently. And I don't think that's available to incumbents right now on all those aspects.
And one more question from Emmy Fong. Some people say Hong Kong is a very trading, gambling-oriented market. Not sure if this is true across Asia. Is there a gap between what's good for investors versus what they want? How do you overcome this gap?
Yeah, this is true. I mean, there've been a couple of studies in terms of the number of penny stocks Hong Kong investors buy, and I do have some slides on this in terms of the percentage of people investing in this kind of stuff. So, people like to double, triple your money quickly, but investing is a patient business. So it depends on what you're looking for. There is a gambling mentality, and there's you can see from the IPOs and what's happening on the IPOs and the oversubscription levels and how they trade on day one, etc., etc. So that's again, as I mentioned, difference between Singapore, Hong Kong. It's intrinsic to the nature of and character of the place.
Tim, you have any thoughts on that one?
Yeah, and just I mean, particularly having come from an insurance background, is that people in Hong Kong and in Asia generally, that they have two hats that they wear at the same time. So way more gambling in terms of their approach to trading and like signing up for IPOs and all this kind of stuff. But at the same time, we still have retail long-term savings propositions or products delivered by insurance companies with guarantees, no upside opportunity whatsoever. So it's kind of like you've got two ends of the horseshoe and sort of the sort of nothing in the middle. And I think that the opportunity then is to kind of bring those two sides together for a sort of direct long-term savings and investments sort of platform, which has the best of both worlds. So it's I think it's reflective of the opportunity rather than a kind of like an inherent problem itself.
Right. Sebastian, your thoughts?
Yeah, like so I think from our point of view, like we do a lot of education on long-term investing, and this is clearly our, like that's what we recommend, people. I do see these numbers Vivek was referencing, right? That the number of penny stocks bought and so on. But I think we are trying to do a lot to get people towards a more long-term approach and a bit more towards this get rich slow, but probably with a bit more probability rather than buying penny stocks.
Right. And one more question from Will. I mean, we take a look at Hong Kong, still quite a small market. How do you intend to get a bite of the big cherry in mainland China? You guys have any plans there? Or?
Well, mainland China is a pretty sophisticated market. I mean, compare on a comparative basis. I mean, it's of course different. I don't know whether it will work well in terms of having domestic products, because obviously there's a limitation in terms of what you can do. I mean, it's only now you can construct portfolio with some fixed income dynamics. But I mean, I think all of us, I mean, we are definitely catering a lot to the offshore Indian wealth, for example. I mean, we have a lot of products for offshore Indian investors, and there's a lot of potential available for offshore Chinese investors too. So definitely those are the two markets we're going for. But domestically, I think it will be determined by the products available, because at the end of the day, we do look at global allocation, global diversification, etc., etc. So that may be difficult to do if we were purely domestically based in China.
How about Sebastian, Tim?
Yeah, no, I can only echo what Vivek already said. I think mainland China, I think is actually a very sophisticated market in many ways. Yuebao and similar things. So I think we don't necessarily have an ambition to go to mainland China. We will expand in the region over the next 18 months, but China or mainland China for us is not a particular focus.
What about yourself, Tim?
Yeah, and sort of echoing the comments of you got to have a very good differentiating factor to be successful in China, given where it's already at. The one reason that I think we can kind of be attracted to that is then the role that Hong Kong can play in the GBA. So there's definitely something that could be leveraged on that, and as the sort of wealth kind of aspect of that starts becoming clearer. But for now, that's kind of limited to the banks rather than independent wealth managers. But now we're interested to see kind of how that regulation comes through over the next few years. That might change a bit. If not, it's a hard task to kind of break into that.
Yeah, I think we're at the top of the hour. Super interesting. I mean, any closing remarks from anyone on the panel, maybe Vivek or Tim, Sebastian?
Yeah, I mean, I think we should, as FinTech Association anyway, we should promote, people adopting or trying out. And that's what I always say, you need to try out some of these new technologies that we are using and all that. And, I know it will come over time, but people should definitely take advantage and see what's on offer with all the other FinTech companies, not just in the wealth management space, but also in payments and FX, etc., etc. So I hope more and more people can try us.
Tim, you have any thoughts?
Yeah, similarly, I think it's a very exciting time and space to be in, and picking up on the earlier comments, like we are only, as an industry, it's only just starting. There's sort of 1% done, and so 99% of the work still to do. And I think the more we can engage together, the more we can attract people to be early adopters and to go through those sort of growing pains and help iterate and improve, then the better for everyone. And really optimistic about actually what those steps are, and then how that then helps more and more people become engaged with the important aspect of saving and investing for the long term, or as Sebastian says, sort of like getting rich slowly, but sort of doing it in a way that is with a higher chance. And so kind of making wealth management more accessible and more fair for more people is something that we're kind of setting about on a mission, and really excited about the path over the next few years.
Sebastian?
Yes, I think everything is said. There's not much more to add, but I think if I see the numbers that there's 1% of wealth actually with digital wealth managers, that makes me more excited than anything else. So I think that just shows how big the potential is.
Right. I thought you guys would be, offering up referral codes or something like that. But no, it's been fantastic. So really excellent. I love the discussion. I'll hand it back over to Julie to kind of close out the session. So.
No, I mean, that's great. I actually didn't, all the questions I wanted to ask actually were asked by the audience. So I think that's, really good engagement there as well. No, thanks very much for your time, Sebastian, Tim, Vivek, and also to everybody else for joining the session. We managed to get through all the questions. So normally we would have to get back with some written answers or something, but that's great. It was very efficient. Look, I think, Vivek, I know you've been a long-standing member of the WealthTech committee. I know this is probably the second or third time that you've had to do a bit of an intro, but we always have good, new members, and I know that you've been involved in your solution, so it's been great just to hear your success. It's been great for me as well to listen you, Tim and Sebastian, and actually today, UBS invited me to go for their digital summit to talk about client experience 2030. I wish I'd had this session before I had to really try to find some great insights to share with, I think, 600 people logged in from UBS to listen to me about client experience. I think you guys have done a much better job about explaining some of the challenges. And, it's truly speaking, I think for them, the Q&A was very different. Let's just say to the Q&A that we had here today. So fascinating stuff. Thanks, everybody. Nothing else from me.
Yeah, thanks a lot, Julie. Thanks, thanks, Neil. Thanks for putting
together.
Yeah, thanks very much.
Appreciate it. Okay.
Thank you,
Bye-bye.
Niels. Thank you, Julie.
Bye.
Goodbye.
Take care.